Thanks for joining us today on The Close. I'm Morella Fernandez. Market close in a half hour's time. Let's get to the stories we are following out of the BNN Bloomberg newsroom. The Canadian economy added over 53,000 jobs in November, close to 53,000 jobs, exceeding economists' estimates. It's a third straight month of gains, most for part-time roles in the private sector, and it was positive for younger Canadians. That group has been facing difficulty getting into the market. The unemployment rate fell to 6.5%. Laurentian Bank of Canada reported revenue for its latest quarter that came in below Bay Street expectations. Profit also fell 16%. The bank set aside more money than expected for possible bad loans. Now, at the start of the week, Laurentian announced National Bank will acquire its retail and small businesses, while Fairstone Bank will acquire Laurentian for $1.9 billion. Stellantis has received a default notice from the federal government for moving production of its Jeep Compass SUV to the U.S. The industry minister, Melanie Joly, says the automaker is in default on financial aid. Governments in Canada have pledged more than $500 million to Stellantis for costs at 2 assembly plants. Joly has been in a dispute resolution process with Stellantis to bring production back to the Brampton, Ontario plant. And shares of Netflix and Warner Brothers Discovery moving in opposite directions today. Netflix has agreed to buy the film and TV giant in a cash and stock deal worth $72 billion US. So under the terms, Netflix will pay $27.75 US a share and will gain control of Warner's film and television studios, as well as HBO and HBO Max. The deal set to close after Warner completes its plan to separate its global networks division into a standalone, publicly traded company. The acquisition is one of the biggest entertainment deals in history. And right now, here's where we stand on the markets. The TSX 180 points down at 31,296, a day after having another record close. Let's move south of the border. The S&P 500 only 13 points up, so not a great move today. The Dow Jones 114-point move up on the day, about 0.2%, and the Nasdaq gaining 60 points so far on the day. We're getting to the end of the year, and the Canadian economy is showing some unexpected strength, including in the new job numbers out today. Let's start there with Sébastien McMahon. He's portfolio manager at IA Global Asset Management. Thanks for joining us today.
Hey, a pleasure, Marla.
What do you see as continuing to support jobs these days?
Well, the Canadian economy, we think, is getting some mojo back at the end of this year. We kind of spin positively the fact that it's mostly part-time work that we're seeing here. I mean, when businesses feel less confident, those are the first jobs that go, especially in the youth side. But now that we're seeing businesses starting to rehire part-time workers, especially the youth, and when you mix that with the CFIB business barometer, which is also shooting a little bit higher, it seems that businesses are getting their mojo back. So this is a good development, because the key to the Canadian economy will be to get businesses, the private sector, to invest again in 2026. So we might not be there on the capex yet, but we feel that the pieces are there for the businesses to gain confidence. We have all of those cuts from the Bank of Canada that are now a tailwind for the consumer. So we feel that we have a setup for 2026 to, let's say, outperform a pessimistic consensus. I was looking at the Bloomberg earlier. 1.2% is expected for growth in 2026. We think we could be closer to 2% for sure.
Okay, so the part-time work, and you mentioned a lot of that going to young people. Was it in retail or elsewhere? We would expect it to be in retail at this time of the year with the Christmas rush.
Yeah, exactly. And we're seeing this as being rather, well, broad-based. We're seeing Quebec, we're seeing Ontario having lower unemployment rate, and the real employment rate that we're seeing now globally in the country is the lowest that we've seen in 16 months. So, there are some good reasons to like the Canadian economy. The one risk for 2026 will be the USMCA thing. And, of course, we've heard from Jameson Green, the U.S. Trade Representative, that Mr. Trump will likely want to withdraw from USMCA sooner rather than later. So likely we will be headed towards bilateral trade discussions early in 2026. The hope would be that Canada and Mexico, they want to stick together. They want to negotiate as a bloc. Likely there will be bilateral trade the discussions that will be had. Canada, we hold a few aces up our sleeve with the energy sector that could help as well. Businesses looking at that, of course, you could have some more uncertainty for the beginning of 2026, but you need to start to ask yourself at the other end of this thing, on the other side of this thing, could we negotiate a way out of the steel and aluminum tariffs? Could we get eventually something that would be a better deal than the situation that we're in now? I think those will be the key issues for 2026.
Okay, so let's get back to Canada for a moment in the sense of, I'm wondering if you expect the Bank of Canada then to hold this month.
Yeah, that they were, of course, 100% on our end that they will be holding. Likely they will be striking a more positive tone because of the recent revisions that we've had to Canadian GDP data show that the Canadian economy is, in fact, a bit stronger than what was expected. So that does bring the ghost of inflation back. Maybe that explains why inflation has been more resilient than expected, so above 2% over the last, most of the last few months. And with the labor market starting to gain as well, you have to start to price in the possibility that it hikes again in late 2026. Not our base case scenario yet. We think they're more on the risk management approach. We think this is the right thing. But of course, this could support the Canadian dollar, which has been on a good stretch over the last few days. And we're still bullish for the Canadian dollar in 2026.
Okay, before I dip more into 2026, you see 2025 as a year of extremes. Can you explain that a little bit?
Yeah, well, we've had Trump 2.0, we've had the trade, the issues, we've had AI. I'm just off the conference circuit in the fall. I mean, every economist like myself, strategist, we're on the road. We get to meet other people. We're on panels. And I was surprised that I heard quite often the baseball analogy that the global business cycle now is in the 7th or 8th inning of the baseball game. We think we're more in the 3rd or 4th inning because our main leading indicator, which is what we call the monetary policy cycle, is actually pretty much at the highest level that it's been over the last 25 years. There's been lots of coordinated cuts by central banks around the world over the last few months. China is doing what it can to support its economy, both on the monetary and the fiscal side. And the Fed is not even through with its own cutting cycle. So we are optimistic. We're not thinking about the end of the baseball game. We're thinking acceleration here, not exhaustion of the global business cycle.
And you mentioned that Canada has a bit of an edge or an ace in its pocket, and that essentially is the amount of energy we have and can provide to the world. Can you expand on that as well?
Yeah, well, the U.S., at least more than 50% of the U.S. oil imports come from Canada. I mean, they need us. They need the energy. They need electricity. We have a few good plays here in Canada, a few good companies that are well positioned to support the U.S. there. If you ask U.S. businesses, the relationship with Canadian and Mexican businesses are very important. We had a Globe and Mail article this morning quoting that the Chamber of Commerce in the U.S. is putting ample pressure internally on the U.S. government to stay with USMCA and be done with those tariffs. So we think that this is necessary for the business model of the U.S. So we do have a few aces up our sleeves. Let's see what we can get out of a negotiation, but we should expect that at least the narrative, the overall narrative in the media, is likely to get much worse earlier this year as Trump pushes against USMCA. But at the end of the tunnel, likely we could be somewhere that would bring more certainty to Canadian businesses than the rut that we're in now.
Sebastian, I'm going to leave it there with you. I'm out of time. Thank you for your time. Appreciate that.
A great pleasure. Thank you.
And we'll continue our coverage of Canada's payroll data in just a moment. Stay tuned. My next guest says Canada's strong payroll report for November suggests the country's economic prospects for 2026 could be bright. Let's go to Bediak Seshazai, Executive Vice President at PIMCO. Thanks for joining us today.
Thanks for having me.
So the unemployment rate has dropped to a 16-month low, and that follows, of course, a decent GDP report. What do you think is driving momentum for Canada?
Well, I think it's a combination of a few things. First and foremost, the Bank of Canada has obviously delivered a pretty deep rate cutting cycle, lowering the overnight rate to 2.25, which in our view is slightly stimulative for the economy. They've cut rates more than most other developed central banks. I think that is certainly supporting the economy. It's making people more optimistic on the future. The second thing is it's been a month since we got fiscal uncertainty out of the way with a more growth-oriented fiscal budget. And I think that is a big deal for businesses because remember that we were kind of stuck without a real understanding of the fiscal picture for most of this year. And that probably put businesses in a place where they didn't really know what was coming. And now that they know what's coming, they can be a little bit more confident and start to make some hires, even if those are part-time hires. And then I would say, the third factor is that to some extent, I think Canada could be benefiting from low base effects. You have had a fairly long period of very weak growth. You're starting with relatively low comps. And particularly for the unemployment rate, we think a bigger factor in driving the unemployment rate lower is not so much that a large number of jobs have been created. It's just that with no more immigration and a falling participation rate, you don't really need to create as many jobs to lower the unemployment rate, which I actually think is a pretty important thing to also keep in consideration. In fact, we only estimate that with the current level of immigration, we need about 10,000 jobs a month to keep the unemployment rate unchanged.
Interesting. And those looking for a job dropped by close to 26,000. So a decline in the labor force, as you mentioned. And do you think that's a trend we will continue to see?
The immigration side is certainly poised to stay as it was this year for next year. We're certainly far away from the high levels of immigration that we saw in 2023 and 2024. So that is likely, in our view, that is likely to continue. The hurdle for job creation in the economy is not going to be as high as it used to be. And so you could have the unemployment rate drop a little bit further if we got some good traction on job creation. And more importantly, I think, we'll be looking for those part-time jobs to, turn into full-time jobs at some point.
You mentioned youth unemployment, which has been terrible for most of the year, but now is beginning to pick up. Is there an association here with the part-time work growth that we are seeing?
Yes, that certainly could be the case. As you mentioned in your, previous segment, I think, as we get towards the fourth quarter, there certainly tends to be a lot more hiring in several service-focused industries as well as goods-focused industries just to support kind of holiday consumption. So that can certainly be, one of the factors driving the youth unemployment falling. And that's why I think we should also not, be too confident about these numbers. As you know, these labor force numbers do tend to be fairly volatile. We do have another survey, the summary of employment, which is typically a delayed survey, and that's been indicating something very different from what this has been indicating. It suggests we actually lost jobs in the 9 months to September. So, this is very promising, certainly, but at the same time, I think there are certain headwinds that the economy has to navigate in 2026, and we do need to see other data corroborate what today's survey is saying.
Yeah. So we were talking about some of the part-time work, which could be in retail, but we did see that jobs were lost overall in wholesale and retail. And I'm wondering if you think the tariffs are still the biggest headwind facing the economy.
Certainly. I mean, that is the biggest wild card going into 2026. And particularly if the USMCA were to be, renegotiated into a bilateral trade deal, I think that could certainly leave this uncertainty pending for quite a while. Now, we do think that eventually there is a strong case to keep the USMCA together, both for the US as well as the trading partners, Canada and Mexico. So we think that there's a pretty good chance that USMCA survives, although it could be subject to more frequent reviews. So rather than an 8-year review, it could be more like an annual review. But at the same time, I think trade will continue to be a big source of uncertainty. The U.S. economy itself is also another source of uncertainty. If the U.S. economy were to slow down or stumble, if the AI cycle, which has been a big source of strength for the U.S. economy, that were to start to slow down, I mean, those are all things that could, eventually spill over into Canada. We're also still a little bit concerned about the housing market, particularly in Ontario, and especially with the modest rise in rates that could accompany a stronger job market. That might not necessarily be good for the housing market.
Vinayak, you mentioned tailwinds for the Canadian economy for 2026. We have the budget announcement, a lot of infrastructure push. What else do you see as acting as a tailwind for Canada?
Well, the biggest tailwind in our minds would be a successful renegotiation and outcome to the USMCA, which, we would put a fairly reasonable chance that happens over the next several months. As Prime Minister Carney has been pushing quite aggressively for talks to continue. And we do think the U.S. has largely concluded a lot of the other important trade deals with several other partners. So the focus is likely to shift to the USMCA in coming months. And I think if you got a good resolution to that if anything sees even the existing level of tariffs preserved or even lowered on Canada, I think that could spur a lot of new investments, that could spur a lot of new projects. The fiscal budget itself creates a lot of incentive for new investments, like things like the accelerated depreciation, et cetera, are all, they do create a strong incentive the government has put in place the framework that should allow businesses to want to invest and hire people. And then we don't have a lot of new labor force entrants into the pool because of lower immigration. So I think to us, that combination could set the Canadian economy on a as I said, it's possible that we've turned the corner and we are now recovering and we'll see brighter prospects in 2026.
All right, Vinayak, I'm going to leave it there. Appreciate your time. Thank you so much for joining us. Vinayak's Executive Vice President at PIMCO. And coming up, Donald Trump's 50% tariff on aluminum causing Canada to shift exports outside of the U.S. But is it sustainable? We'll take a look in a moment. Since U.S. President Donald Trump raised the aluminum tariffs to 50% in June, Canada has been shifting its aluminum exports to other parts of the world. Our next guest says the high-level tariff on aluminum is not sustainable. We spoke with Jean Simard, President and CEO of the Aluminum Association of Canada.
The situation with a 50% tariff is highly disruptive for an integrated value chain, industrial value chain like we have in North America, across Canada and U.S. The access to the European market has always been there in the past, but since we're a truly integrated market in North America, the first place where metal wants to go because of market attraction is the U.S. So we had to revert to ship to Europe temporarily over the summer because the transactional price for aluminum was not factoring in the total cost of the tariff. It took some weeks, and finally it has reached a threshold where metal is attracted back into North America, which means that more and more through the coming weeks and months, the end user, the consumer, will be hit by the full impact of the tariff, which will become more and more unsustainable, disruptive, and potentially create some inflationary pushback in the U.S.
And so now, sorry, just to clarify, the price to sell to the U.S. is more appealing right now than Europe?
Well, it's gone back to a situation where the tariff impact on our shipments to the U.S. are, I would say, neutral, whereas over the early month of June and then into July, the price was not factoring in the total cost of the tariff. So we were basically losing money shipping to the U.S. We lost about $600 million over a matter of weeks, which brought Canada, the Canadian producers, to ship or to avoid shipping about 45% of the metal that normally goes to the U.S., keeping some in Canada and shipping some to Europe. So it was a matter of avoiding losses, and the best way to do that was to ship to Europe, which offered a better or less disadvantageous position. So now that the market is paying or factoring in the full cost of the tariff, the situation for us to ship to the U.S. is not as impactful as it was before that.
Now, are you still shipping similar numbers then, or will you start shipping similar numbers to what you did before then?
We're getting back there, yes.
And which is, I guess, is good news for your group, but it's the consumers and everybody else is paying the price. So where does that leave you? Where does that leave Canada when it comes to the U.S.? You still want to see, obviously, the tariffs eliminated.
Yeah, logistically, the U.S. market makes far more sense for us than any other market, although since our smelters are seaborne for the most part, we have the option of shipping, as we've done over the summer, to other markets. But as much as we can, this is a market in which we've invested ourselves for decades. We have long-time clients. We have a very good reputation on the U.S. market. So hopefully this whole tariff situation will land in a more favorable place at some point in time, meaning here a very differentiated position for Canada versus the rest of imports coming from other places of the world, such as the Middle East, India, or Australia, as an example.
And sorry, I just want to ask about the seaborne smelters. Does that mean they're on the water, easy to move, easy to load and ship?
Yeah.
Okay.
Exactly.
And with everything that has gone on, have you developed some new markets though outside of the U.S., or is that something that doesn't come easily?
Well, it's the way our industry is structured. We already have the three players, which is Rio Tinto, and Alcoa and Alouette, all have a footprint in Europe. So they either produce already from Scandinavian countries to ship to Europe, in Iceland as an example, or as the case is with Alouette, the Setil smelter, they have shareholders who are of European origin who have been taking the metal from Setil and shipping it to Europe for decades now. Mm-hmm. So we already have a very established footprint in Europe, which means that basically, since we're producing at full capacity, the metal will either go to the US market or go to the European market, all depending on what we call the netback, which is the market that gives you the best return for your shipment.
Jean Simard is President CEO of Aluminum Association of Canada. Up next is Closing Bells on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, CCH Holdings ringing the closing bell. In New York, Julie Caperton, head of the private bank Wells Fargo, ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX today dropping 167 points, or about 0.5%, taking it to 31,311, so no record close to follow yesterday's. Let's move south of the border. Not a lot of movement for the S&P. It's 13 points up on the day. The Dow Jones has a 104-point move up, or 0.2%. And the NASDAQ gaining almost 73 points, just shy of that, about 0.33%. Let's get to the movers in Toronto. A big drop today for Orla Mining. It dropped 11%, or $2.13, taking it down to $17.10. Fairfax Financial selling $400 million worth of shares as it rebalances, and that's what is taking that stock down. Let's get to this. NextGen Energy moving down today. It dropped 6% flat, or 83 cents, to $13 flat for the end of the trading week. Energy fuels also a decliner today. It lost over 5% or $1.19, but it's still 123% up over the last year. On the upside, Peyto Exploration gaining today close to 2%. TD Securities raised its price target to $25 from $23 and kept a buy rating on shares, so that moved Peyto Exploration. G Mining Ventures also a gainer on the day. It was up 3.3% or $1.06 to $33.48, a 211% gain over the last year. Birchcliff Energy, the last one to round us out today. It moved up today about 2%, just over, a gain of 17 cents. Delayed inflation numbers were shared today in the U.S. The Personal Consumption Expenditures Price Index came in at 2.8% for September. Let's discuss with Michael Green, Chief Investment Strategist, Simplify Asset Management. Thanks for joining us today.
It's a pleasure to be here.
So it's the last reading the Federal Reserve gets before it makes an announcement next week. But how much does it matter considering the information from September?
Yeah, I don't think it matters very much at all. I think the Fed is highly likely to cut. We've been told this by multiple members of the Federal Reserve. This will be another hawkish cut in which they indicate that very well they may pause and not continue. The simple reality is that the inflation data is muted relative to the runaway expectations people had had earlier in the year. Now we're starting to see increased concerns around the labor market that will lead the Fed to cut.
Talk to me about the concerns around the labor market, again, because official data has been delayed, and they're not going to get the most recent data until after they make their announcement.
Well, they've indicated that they're very closely watching private sector data. We got data from Revelio. We got data from ADP that is current. Both of those suggest that the economy is weakening, that the labor force is weakening. There are some positive developments. Again, we have delayed data that's coming out from the official sources about the composition of jobs in the United States. There does appear to be a bit of a rebound in employment for those who were born in the United States, which has been one of the objectives of the Trump administration. That remains to be seen. We'll see if that process continues, but the private sector data is telling us that the economy is weakening.
Okay, because it is so highly expected that the Federal Reserve will cut, do you anticipate it to move the markets?
I don't think it's going to meaningfully move the markets. I do think the language that is used, depending on how hawkish the speech after the release is and the language that accompanies the release, how hawkish that ends up being, that could lead to somewhat of a backup in long end yields. But I think the most important component that people have now realized is that long end yields are not running away from the Fed. This is not an issue of if they cut, then we're going to end up with 6 or 7% 10-year yields. There are scenarios in which that can happen, but they seem implausible given the current status of the economy.
Okay, we have seen more volatility lately through tech stocks, generally moving out of money or moving money more across the board. Do you expect volatility to continue through the end of the year?
Well, I think what we're seeing right now is a little bit of a tug of war. So some of the leading stocks have started to lose some momentum. People have backed away from the idea that the only answer is to buy the Mag 7. We're seeing, and you're seeing this in Canada's markets as well, we're seeing late stage cyclicals. We're seeing things like energy, et cetera, begin to benefit a little bit. We've seen commodities rally. Those tend to be either early stage, which could indicate a recovery in the United States. We've effectively had a near manufacturing recession for roughly 2 years in the United States. I know Canada has suffered alongside us in that front. If we are actually at a point at which the cyclical portion is rebounding, that would be one explanation for some of the stuff that we're seeing. The other component is simply that it's late cycle. People are looking to rotate. They're not sure what direction it's going. And the very large sums that can come out of a company like NVIDIA to effectively buy the entire small cap index at a similar market capitalization suggests that rotation could continue for a little bit, giving us the volatility that we've been experiencing.
Okay, consumer sentiment seems to be slightly better now than it was. Considering the weakness in labor, why do you think that is?
Well, I think it's a combination of factors. One, the fears about inflation have begun to back off. That's one of the key components that jumps out of the Michigan survey, which, I think it has its methodological issues. We got to be very careful in how we interpret it. But it does suggest that conditions have improved slightly, both around expectations of inflation and, as I indicated, some elements of job losses appear to be concentrated in the immigrant community in the United States. We are seeing rising native-born employment. We would expect that to show up in consumer sentiment as it appears to be doing so.
Okay. Do you think, considering the numbers from sort of Black Friday, Cyber Monday, that weekend in between, what you're seeing with consumer sentiment, does that bode well for Christmas retail?
Well, I think what we're seeing, unfortunately, is far less discounting. Inventories have gone into the end of the year at much lower levels than they did last year, where the fears of tariffs effectively pulled forward a lot of spending. Unfortunately, we're seeing an uptick in the usage of credit, whether that's credit cards or buy now, pay later, that suggests that people are hopeful and therefore spending a reasonable amount, but the absolute quantities that people are buying are not nearly as robust as what we're seeing in the pricing components, which reflects much lower discounting this year.
All right. Let me ask you about what your strategy is for year end and starting into next year. How would you advise investors?
Well, the point that I continue to emphasize for people is when you see fixed rates back up, when you see the 10-year moving significantly above 4%, as it roughly is today, by and large, that represents an opportunity to lock in real yields that most of us have not seen for a very, very long period of time. I'm skeptical about valuations in the equity markets. I'm very aware that they remain highly contingent on employment in the United States. And so I'm nervous about the equity markets. I'm opportunistic in the fixed income markets.
All right. I will leave it there with you, Michael Green. Appreciate you joining us on the program. Thank you.
Thank you.
Coming up, shares of Netflix under pressure after announcing a deal to acquire parts of Warner Brothers Discovery. More in a moment. In a blockbuster deal, Netflix announced it's buying a storied Hollywood studio, Warner Brothers Discovery. So what does this mean for the streaming giant? Let's go to Matthew Dolgan, senior equity analyst at Morningstar. Matthew, you don't think this is necessarily positive for Netflix. Why?
Well, put simply, we think they're paying too much. We think that the Warner Brothers Discovery assets that Netflix is getting are really unique premier assets that will be a big benefit to Netflix, but not at the price it is paying. And in our view, it seems a little bit like, I don't want to use the word desperation, I wouldn't go that far, but an acknowledgement of a weaker business than maybe the market would have assigned for them to pay this type of price for these assets.
Okay, and we should let viewers know it's about $83 billion, including debt, so 82.7 US. Are you concerned about integration, how this will work?
In part, yes. I wouldn't necessarily describe it as integration per se, but it is about how they can monetize this business to a greater extent together than they can apart. And so the market, obviously, before the rumors of Warner Bros. Discovery being up for sale went out, was valuing Warner far, far less. Our valuation on Warner, which was higher than the market, was still less than this. And so how do you come up with 50% greater value than even we assigned, which, let's say, for this business would have been about $17 to $18 per share? And it's through enhancing revenue and profits. Certainly, like always, there's going to be some cost savings. We don't think that's enough for this alone. And on the revenue side, although we do think there are many areas where Netflix can better monetize some of Warner's assets than Warner can, we also think that as you contemplate how these two huge streaming services will work together, you're inevitably going to initially take some lower revenue from subscribers who subscribe to both. It's to be determined how they will go to market with bundling or integration of the two platforms. But one way or another, we wouldn't expect for a subscriber who currently subscribes to both to pay the same amount as they subscribe to both. And we think there's a lot of subscriber overlap.
Okay, so at some point it could be more money for subscriptions. Netflix putting down a large amount of cash in this deal. Was that, do you think, the incentive for Warner Brothers Discovery to take this?
based on all the reporting we've seen, that doesn't seem like the primary consideration. From what we understand, the Paramount offer was probably even more cash. It would have been for all of Warner Brothers Discovery. So they're not apples to apples deals, but it probably would have been comparable, and it probably would have been even more cash in the pockets of Warner shareholders. So no, we don't think that cash was the overriding factor in Netflix making the decision it did. And there will be, the story is ongoing, whether there will be controversy, litigation, or further developments, and Paramount not necessarily giving up yet. All remains to be seen as well.
Yeah, we should. I'm glad you added that, because there are opportunities for counteroffers. And Paramount, Skydance, accused Warner of favoring Netflix, claiming there was a predetermined outcome for the bidding process. Did they provide anything to back up that claim?
No, we didn't see anything that really backs it up. And even, to further counter that, based on what this what Netflix and Warner did agree to, it's harder for us to see how Paramount would really have a case that this was anything other than meritorious, that Netflix won. It was a really high offer in our view. Again, that Discovery Global business, which Netflix is not acquiring, Warner shareholders will continue to hold. It'll have a little bit of value, not very much. We expect maybe about $3 a share, but that does go on top of the $27.75. And so it's certainly far from clear that Paramount's offer was better, if at all. And then as far as an argument about which has an easier path to regulatory approval, we don't think that shareholders are worse off necessarily, certainly not clearly worse off, going with one versus the other. We think each of Paramount and Netflix have regulatory hurdles that they would have to get through, that on the merits, one doesn't clearly have an easier time than the other, even if there are different factors depending on which company needs the approval.
Okay, so they both would have challenges doing that for the same reason, that they would just be too big and almost have a monopoly in the entertainment business. Do you see Netflix getting past this?
Well, and so in Netflix case, it is the streaming market between HBO Max, which is the fourth biggest provider in the U.S., and Netflix, which is the biggest. That's the biggest regulatory hurdle there. For Paramount, it wouldn't be that. Actually, those two streaming services we think really did need to be together for the benefit of the market. But between the film studios and sports rights, there are other reasons why Paramount would have had its own hurdles, in terms of regulatory approval. To your question about whether Netflix can get this through, that's a question. We're certainly not saying that we think that it is a likelihood. We called it a toss-up. We don't ultimately think that consolidating the top and fourth biggest streaming providers should itself preclude this deal, but a reasonable argument can be made that that alone should preclude it, especially with streaming becoming more and more important. And so, yeah, it's going to be a challenge, and that's even apart from whether you have Paramount putting its nose there. And I know the White House has already kind of come out and said skeptical of this. And so Netflix has a big lift ahead of it to get approved, and it's not a foregone conclusion. A
quick question about whether you think movies, if the deal does go through, Netflix will still have movies in theaters, because that seems to be a question as well.
That is a great question, and it's one of the reasons why we say Netflix is likely going to have less monetization right off the top than Warner does. As far as whether they put movies in theaters, it seems like at this point, yes, they probably will. But the second question is, do theaters stay exclusive, or do movies stay exclusively in theaters for as long? And that's a much bigger question. So although before today we wouldn't have said, oh, certainly there's going to be just as many movies in theaters, maybe there will be, maybe Netflix is committing to that. But even if it does, is it keeping them exclusive for as long? And if it doesn't, and if it really wants to rush to get those films to its platforms, which we think it does, that's its business model historically, that ultimately leads to less opportunity in theaters and less theater revenue. Again, another hurdle for Netflix to get over, not to mention what it might mean for the theatrical film industry.
Matthew Dolgan is with Morningstar. Matthew, thank you. Appreciate that.
Thanks.
Shares of Canadian logistics technology company Descartes jumped this week after they reported their latest round of earnings. We'll get more from the company's CEO in just a moment. A new report suggests more and more Canadians are turning to technology to help save every little bit at the grocery store. CTV's Alison Bamford looks at the new cost-cutting apps.
I need apples.
Wally Atawoyan is looking for the best deals on groceries.
If I can get the cheapest, I will definitely go for it.
Helping in the search is an app he created, MyFlyer. It allows consumers to compare prices, and if shoppers are willing to go to more than one store, it can generate the most cost-effective trip based on drive time and gas.
If you can get that kind of information at your fingertips for cheaper, locally, I think that would be great.
Atawoyan still needs food price data before the app can go public. It would add to a growing list of digital supports that already exist. Some connect consumers with discounted items nearing expiration. Others allow them to browse digital flyers. But experts say even that can be limiting.
Not every product makes it into a flyer on a weekly basis. So there are deals in stores that retailers are offering that people do not know about.
BetterCart Analytics is working on its own app for the new year that would give consumers access to a full catalog of product prices.
We'd like to be able to show consumers what is a regular price and how far or deep that promotion actually is if it is on sale.
Reducing the amount of food waste can also stretch a household budget without the need for an app.
We want to buy just what we need. We want to use it up after we make it, and we want to store it right.
Understanding best before dates is also key to limiting food waste. The date refers to peak freshness and doesn't necessarily mean the product has gone bad. Alison Bamford, CTV News, Saskatoon.
Shares of Descartes Systems down on the day, but up 12% in the last 48 hours after the logistics company reported strong results for its latest quarter. The CEO of Descartes joins us now, Edward Ryan. Thank you very much for joining us. Appreciate that.
Hey, thanks for having me.
So you're essentially a supply chain logistics company, which I imagine may have been a real mess this year, considering the rerouting tariffs brought on. How would you describe the year to date for you?
We're really a supply chain and logistics technology company. We sell software, and we run a network called the Global Logistics Network that connects most of the supply chain and logistics and transportation participants together and enables them to execute transportation moves. It's been getting better throughout the year. We've been, continuing to be very profitable, but revenue was a little flatter earlier in the year organically, and it's been picking up this quarter. You see the move up in the stock was largely due to our organic revenue jumping up a couple points in the last quarter.
Were tariffs essentially a curveball to the business?
I think that the changes in tariffs created a situation where a lot of the customers they weren't as quick to make shipping moves because they were worried about what's going to happen to the tariff price tomorrow and the next day, and they didn't want to be stuck with goods that came in at a higher tariff rate. And that complexity caused them to kind of freeze for a little period of time, maybe in the first and second quarter. And as a lot of these trade deals got put in place, and most of them are in place now, that kind of started to get the shipping process moving again, and that's at least a little bit behind the move in our organic revenue growth. Okay,
so Edward, where do you operate in the world, and what part of the world proved to be most challenging, if that sort of came up for you?
We operate all over the world. We get we do business in 140 different countries. A lot of the business that we have on the subscription side of our business has been booming since the pandemic. And that continued, through this year. The transaction processing part of our business, it's about 30% of our business. That was kind of flat earlier in the year and starting to pick up now. We've had a lot of competitive wins, even in a flat period of time that had our revenue going up in the face of flat transportation transaction volumes. So that's been helpful to us too, and it really started to pick up this quarter, which is why you see the jump up to 7% organic growth. And maybe our EBITDA margins jumped up again up over 45 to maybe 46%, which is helpful as well.
11% revenue growth I saw there. So you run because you're running a business that deals with logistics and software as integral to that. You've heard questions about the future of software, I'm sure, given the move to AI for a lot of companies. Is this a threat to your business?
Been great for our business. AI revenues, been a small part of our business over the last 10 years, and maybe in the last year or two started to really pick up. As we run a network, I think, a lot of software companies, may see tough times ahead with AI, but, our network is going to use AI, and it already is using AI to help our customers solve bigger and bigger problems. I think it's going to be a big tailwind for us.
Okay, so that's how you're using it within the business, but you don't see your business model threatened by AI?
No, not at all. I think it's helped by it. We probably see 50 or 60 different capabilities right now that AI is going to bring to the table over the next couple of years and add a lot of value for our customers. And no, we don't see it as a tailwind at all. We don't see it hurting any part of our business, really. We see it really actually driving it forward. And we're already seeing benefits from it in the last 12 months. Certainly part of the revenue pickup this quarter is some of the AI tools that we have in our MacroPoint business and some of our global trade compliance business that's already been helpful in growing revenue and helping our customers do a better job for their customers.
Okay, so just wondering what growth prospects or efficiencies you'll gain from AI next year. Is there a dollar value amount on that?
I don't know that we have a dollar value yet, but it's certainly picking up. I mean, you've got two areas where we think we're going to see, noticeable improvements. The back office, which sounds like what you were referring to a minute ago. We'll have efficiencies there, but they're probably going to be eaten up by new features that we're able to produce in AI that we're going to deliver to customers, and that's going to provide revenue growth and fairly highly profitable revenue growth because we already run this network. We have a lot of sunk costs to do it. And the incremental features, when they produce revenue, transactional revenue, they tend to be highly profitable for us.
All right. Edward Ryan, I got to leave it there, sir. Thank you for your time. Mr. Ryan, CEO of Descartes Systems Group. Coming up next, the CEO, MDA Space, tells us about its company's plan to build, test, and launch a new satellite for the RadarSat Constellation mission. More in a moment. Ottawa awarded MDA Space about $45 million to build, test, and launch a new satellite for the RadarSat Constellation mission. It's part of a 15-year investment of over $1 billion for satellite Earth observation through the Canadian Space Agency. The MDA Space CEO, Mike Greenlee, joined us today.
It observes the Earth using radar satellites. We built and launched those satellites in June of 2019. This new announcement is that we've been selected to build an additional satellite to add to the RadarSat Constellation mission, a fourth satellite. And the $45 million award that we just received is really to get long lead parts for that. The full contract will be awarded in 2026 once it's all approved and definitized. But the government was announcing that we will be building that full satellite and that we are launched on our way to be able to start getting parts from our suppliers.
What are the parts what kind of parts need such a long lead time, Mike?
Electronic parts that are being manufactured by different members of our supply chain. And we just want to make sure that they get acquired as soon as possible so that the whole project can stay on schedule once the full contract is awarded.
And do these satellites, do they get more and more advanced as time passes?
They do. We get better at it. This particular satellite, MDA Space has invested significantly in a satellite called Chorus, which is our next generation radar satellite that we'll be launching about a year from now for our commercial purposes worldwide. And this fourth satellite to the RadarSat Constellation mission will be a derivative of Chorus, so we can leverage this latest version of our radar satellite technology and add it to the Constellation for Canada.
Is this for security and military purposes partly?
Radar satellites for the government do a number of things. The Department of National Defense is one of the primary users, so they would be using it to be able to monitor activity around the Earth, monitor ships in the ocean, what have you. It can be also used. Radar satellites are also very good for environmental monitoring ice flows, the ice in the north. Maritime traffic is a big use of it. We've used them for deforestation monitoring in certain parts of the world and a number of other environmental causes as well.
And so we're looking at some visuals here of satellites. Do they have much computing power on board, or do they just send the data back down to Earth and the actual data crunching is done back there?
Historically, satellites have just sent the data back to Earth, and the data crunching has been done on Earth. But there is a transition now with satellites to move what we call computing to the edge and get more computing horsepower up there in orbit on the satellite. Our new Chorus satellite will have an onboard processor that's being pilot tested that will be used to process select radar imagery during operations in orbit and just send the results of that processing back down to Earth, which uses far less bandwidth for communication purposes and can just give you the answer that you're looking for.
That's interesting. So you got the computer on it. Partly it just gets the data down faster, less bytes to move to and fro.
Yeah, that's it. Yeah, so we've with our recent acquisition in the summer of the SatixFy, which is a space-grade ASIC chip manufacturer, we now are vertically integrated with our satellites down to the chip level. So we're able to produce digital satellites now, including the onboard processors or the onboard computer on these satellites, so that we can put more and more computing power on the satellites as we move forward into the future.
A couple of weeks ago, we heard that the government is investing more than $500 million in the European Space Agency. Can you tell us what will that money be used for? I hope some is going to be used for planetary exploration.
Possibly. So what happens is that announcement was made just in time for the Canadian Space Agency to attend what's called the ministerials, which is all the lead ministers from each of the countries within the European Space Agency to get together and decide what their projects are going to be for the next season of projects. Canada took that $500 million shopping bag with them to that session and would have selected a number of different projects that it would like to co-invest in. When they do that, let's say they invested to 10% or 25% of a certain project, then 25% of the work on that project needs to come back to Canadian industry. So that $500 million of investment will create $500 million of opportunity for Canadian industry, which, when leveraged by a typical economic multiplier for space of about 2.5 times, gives you 2 to 3 times that investment in terms of the impact on the Canadian economy. We'll start to learn around December 11th. I believe the Canadian Space Agency has announced what projects they've selected and what areas of investment that they've targeted, and then we'll see what opportunities will arise for Canadian industry following that.
So you are profitable. RBC has a buy on your stock and reckons that you will have diluted earnings per share of about $1.29 this year and $1.34 next year. So you are making money at the current level of business.
Absolutely. MDA Space has been on a great run the last few years. We've been having about 25% year-over-year revenue growth for the last 4 years. We've been persistently generating about 20% adjusted EBITDA through that period of time, and we tend to throw off about 80% of EBITDA as operating cash. So a very strong performing business with a very strong balance sheet.
But just remind us, we just looked at the stock, we're looking at it now, sharply down since August, and that was because of disappointment over the work you were hoping to do for EchoStar.
2 events there. You'll see 2 drops there. The one drop in the September timeframe was a contract that we did have with EchoStar was terminated for convenience. It was canceled because EchoStar rapidly and suddenly changed its business plan and decided to sell its communication spectrum in space to SpaceX. You see a second drop there out in the November timeframe. That was just based on a rumor. So there's a rumor that one of our customers that we have 2 contracts with, Globalstar, was up for sale. And people's perception of that, they assume that maybe that's going to hurt our business. But we're strongly executing on our Globalstar contracts, delivering satellites throughout 2026 as we're nearing the finish of that work.
I know in your latest call, though, you tried to provide more details on Globalstar, but it was difficult. There is some long-term uncertainty.
I think that folks are looking far out into the future, but for our contracts that we have now, that drop you see, people got nervous that they felt, well, maybe if it is true, the rumor that Globalstar is for sale, maybe there's a chance that something negatively could happen to our contracts. Likely a bit of a hangover from the EchoStar effect we saw there in August, September. But our contracts are very intensely performing right now. Everyone's working very hard between the Globalstar and MDA Space team to be able to execute on those contracts and get these satellites delivered to Globalstar so they can launch them into their constellations to provide communications, direct-to-device communication support to their largest customer, which is Apple.
Just very quickly, you've only about 30 seconds. Just remind us, is Canada making progress towards developing its own launch site or sites for rockets?
Yes, maritime launch is continuing to make progress. It had its first suborbital launch recently. MDA Space has recently taken a minority investment position in that. We now have a new member on the board of directors, and we're providing strong support to them because we think that Canada needs a launch to have full sovereignty over the space domain, and we're excited to continue to support maritime launch and advancing in that area.
Mike Greenlee there, CEO of MDA Space. Coming up next, Apple shares under pressure. The company recently announced a number of executives are leaving. More in a moment. Shares of Apple down today following the announcement of plans for two top executives to retire. There has been a wave of departures at the iPhone maker. Let's go to Hatem Diab on this, managing partner, Gerber Kawasaki Wealth and Investment Management. Thanks for joining us today.
Hey, thank you for having me.
Let's start with Kate Adams, General Counsel, retiring. Is that significant for Apple at all?
I mean, I don't think so. I think it's just the change of the guard. You know, I think Apple is really had all these executives for, since basically Steve Jobs was alive 15, 20 years. And I think the management is a bit stale. And the reality is it is a new talent, a new talent pool that they need to draw from. And a lot of these people also have been there for a long time and they're ready to move on.
Lisa Jackson, Environment and Social Initiatives, also leaving. She was overseeing, I guess, diversity. And in the current U.S. climate, it's not a surprise she's leaving.
Yeah, I think that's happened across all of corporate America. The DEI initiatives are just not in vogue right now. So you're seeing that across the board. And for obvious reason, right? Like cut costs and really focus on what needs to be done versus what society wants you to do.
Yeah, it seems what needs to be done for AI, or many are saying, is AI, a strategy around AI. The head of AI also leaving the company. Is that because of the criticism?
I think actually that's the most notable position. Actually, the head of Siri or AI is really the most important job at Apple right now. And obviously, Apple has been lagging tremendously behind all of the other players. And it was not a surprise to anybody for him to leave. He's been there since 2018. He's also turned 60 years old, and he just hasn't really found his footing. And I think having some brand new talent, Amar, the new head of AI or at least Siri, will be coming in from Google. Spent there 16 years, became the head of engineering at DeepMind. So I think that's a huge upgrade and shows how focused Apple is on really making Siri work.
Okay, so why do you think Apple has struggled in the AI venue? Is it just a lack of sort of focus or design by the team it had? Or, I mean, why have they fallen so behind others in this venue?
It's a good question. I think one is a lack of cohesive strategy. Like, we never knew what Apple was going to do. Were they going to build their own foundational model? Were they going to just build models that lived on the iPhone? Apple obviously is known for its privacy, so building a foundational model means that they may have to give up some of their privacy strategies. So I think that lack of like, what are we going to do was problematic. Initially, the fact that they did not have their foundational model was positive because they didn't have to spend all this money building all these data centers and so forth. But now we realize that maybe they needed to do something on that front. But it looks like what they chose right now, and this is probably why they hired Amar, is they would be partnering up with Gemini and Google to use their foundational model or their large model, and then build the smaller models on the iPhone for more private AI conversations.
I was going to say, so how do you think this will work? Tell me more about what Amar brings to the team.
Being a head of engineering at DeepMind comes with a lot of technical expertise. I think the reality is they need to combine both privacy and usability, right? When you talk to Siri right now, Siri asks you if you want to go to ChatGPT to get answers. That just doesn't work. So I think what Amar is going to bring in is a seamless operation around Siri and how they can really combine that with Gemini's abilities to really build this really powerful AI. So I think Amar will bring that relationship between Google and Apple into a new level, basically.
Got it. Adam, I got to leave it there with you, but thank you for joining us on The Close. Appreciate that.
Thank you.
Coming up, legendary investor, Berkshire Hathaway CEO Warren Buffett retires at the end of the year. A look at his legacy when we come back. Legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of the year. This week's Bloomberg's Doc dives into how the Oracle of Omaha changed investing forever and what's next for the company he built.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping those Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick. Both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer-term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing $100 million, $200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high-growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
That is true. All right, that does it for The Close. Thanks for joining us today. Have a good weekend. We'll see you back here on Monday.